Assalamualaikum and hi everyone. Welcome back. This is part B2 of the lecture and examples on MFRS 116 property plan and equipment. In part B1, I have already discussed the initial measurement and I stopped at initial measurement for property plan and equipment that was acquired in exchange for non-monetary assets. And I stop at this slide and I'm now going to proceed with the example, where the example here is the example taken from the textbook, where it's about GHI that conducts its own business in its own building, and that building, which is a property, has the historical cost, which is cost on the date of acquisition of 10 million. And on 1st of January 2007, the business, which is JHI, shift its operation to another location, and it rents an almost similar building from a landlord. So a building was being rented from a landlord. On 1st March 2007, after 3 months, GHI and landlord, both the GHI, which is the reporting entity, and the landlord, that is the owner of the building, now enter into an agreement to swap, which is to exchange their respective buildings. So building of the landlord will be now be swapped with the building of GHI. So that was the case. And open market value of GHI building was 20 million. That was the fair market value of the building that belongs to the reporting entity, while that of the landlord, the one of the landlord, was 22 million. So the one of the landlord was 22 million. 22 million. And in the swap agreement, GHI is required to pay for cash of 2 million to the landlord, and that one is the additional amount that needs to be paid because the value of the building belonging to the landlord was actually higher than the carrying or the value or the fair value, market value of the building belonging to GHI. So you have to determine what are the costs of the new building. New building means the building that is now being swapped, given to GHI by the landlord. That is the building from the landlord, right? And on the basis of fair value and also on the basis of net carrying amount of the asset given up. Remember, there are two bases as we discussed earlier. And also to calculate any profit from exchange, and together with the journal entry, and also to decide which method should be applied by the company. So let's look at what we have here. This is the question that I pasted here already to make things easier to calculate. So the first thing is on fair value basis. On fair value basis, fair value of the building given up mean the existing building of GHI is 20 million. The payment that is required to be made because the value of the landlord's building is slightly higher, which at the fair value that belongs to the landlord now will be in exchange will belong to the reporting entity GHI. So they pay additional 2 million, and the fair value of the new building according to the market price given there was 22 million. So now it has been swapped under fair value basis, and cash needs to be paid to the landlord by GHI. Next, second one is the net carrying amount basis, where on the net carrying amount basis, the net carrying amount at the date of exchange, which refers to the historical cost, was 10 million, and the payment that needs to be made is 2 million. So the cost of the new building under the net carrying amount basis is 12 million. Let's do the journal entries to record the profit from the exchange and other relevant journal entries. Recall from the previous workings for our fair value of building given up. Under the profit will only be realized under the fair value basis, where under fair value basis, the building at cost now, which is the fair value, is going to be the cost, fair value of the building, the new building that was actually being swapped with the landlord, 22. And then the old building has a carrying value of 10 million. That was the historical cost, right? Because no depreciation was actually being assumed here. We have not yet learned depreciation. By the time we learn depreciation, then we'll be able to know how much is the cost, how much is the accumulated depreciation of the old building. But here, no information. And then a bank has to be also credited, and as a result there is a profit, and you can check the workings I put here for the profit, where you take the cost which is at fair value deducted with the carrying value and with the payment that you have also paid to the landlord. Second part is the one under the net carrying amount basis. No profit is recognized. The building, which is the new building at cost, would be 12 million. 12 million is the net carrying amount of our building plus the payment, right, that we are required to pay. So under net carrying amount basis, you can see that the amount or the initial cost of the building is 12 million versus 22 million. So under net carrying amount basis, the reason why it is different because no profit is recognized. Next one is to decide which method should be applied by the company, either the fair value basis or net carrying value basis. This depends on whether the swap exchange of the old with a new building constitute an exchange of commercial substance, meaning that does it bring some cash inflow? Is it certain, or what are the prospect of the future net cash inflow, or of its also the case of whether or not it lacks of commercial substance? That will depend on that, and the fair value basis shall be applied if the company have decided so, if they would expect that there will be commercial reason for the exchange. Now we move on to the next one, which is acquisition by way of trade-in. Still under the same situation, it is still an exchange with normal trade asset just now, but here it is by way of trade-in. An item of property, plant, and equipment can be purchased by a trade-in transaction. For example, motor vehicles, or maybe any other items like equipment, machine, right? You can trade in. The cost of the new motor vehicle or the whatever PPE is normally the equivalent purchase price. And the trade-in allowance given by the dealer or the supplier is regarded as the sale or disposal value of the old vehicle. That is termed as the sales proceed. The fair value basis shall be applied, as there must be some kind of commercial reason for the trade-in. There must always be reason, either for getting more cash as a result of the trade-in, and that can generate cash as well most of the time, if the value or there is still economic benefits could be expected from the asset. So this one you can refer question in the textbook, page 405. It's about JKL trades in an old Mercedes Benz for a new one, and the old Benz is carried in the books at its carrying value of 20 million, and the market price of the Benz is slightly higher, which is 20 million, 20,000, and the market price is 70,000. The cash purchase price, if you are to purchase a new Mercedes on that date, is going to be 250. So it is of course higher, and the dealer give a trade-in allowance. So the old Mercedes could be trade-in for 65,000, and the remaining balance, if they were to get a new one, must be paid in cash. So this is a trade-in. Next, required, what are the costs, or what is the cost of the new Mercedes-Benz? And also to prepare the journal entries. So the cost of the new Mercedes-Benz shall be 250,000, which is at the fair value, the market price, equivalent cash price of the asset acquired. The journal entries, the new motor vehicle, which is the Mercedes-Benz, will be at the fair value. The old motor vehicle will be at the carrying value. You need to go and exclude or remove the motor vehicle, or to let go the old Mercedes with a new one. And as a result, you need to pay the difference, which is the fair value, and the difference would be 185, because this 65 is the trade-in value, and as a result you have a profit of 45,000. Next is by way of where you acquire your property, plant and equipment by way of issuing your company's shares. So you go and debit your property, plant and equipment, and the account that you will be crediting may either be the share capital or the bonds or the debenture. So initial cost shall be at the fair value of the property, plant and equipment, or it can also be measured at the fair value of the shares or the bonds being issued. So either fair value of the shares or the bonds being issued, but it can be either one of the measurement to be the initial cost, whichever is more clearly evident according to the MFRS. When the property, plant and equipment acquired has a market value or a quoted price, therefore the value shall be used, meaning that it shall be the fair value of the PPE to be used as initial cost if it has a fair market value. If the property, plant and equipment has no active market value or quoted price, then the initial cost of the PPE will be determined by looking or by referring to the fair value of the securities issued in the exchange. If the share price of the company is listed in the stock exchange, the fair value of the ordinary shares will have to be in reference to the fair value of the securities issued in the exchange. You can refer details at page 1405. That is the end of part B. I shall see you in part C. And with that, I thank you for watching, and have a pleasant day ahead, and Assalamu alaikum.